Hi, I'm going to talk to you about the solitaire way, what we look for in companies. Everybody in the investment world have their own unique strengths which they bring into their investment approaches. So when we joined this distinguished fund management community as a new player, we were thinking about how we could differentiate ourselves. The only way I thought differentiation would be feasible lies in the way we approach companies. How we see companies would make all the difference, and what we look for in companies will help us find the right companies. So here is what we look for in companies. Firstly, we like to buy industry leaders. We like them to set the context for the whole industry. We would like to invest in leaders in industries which are having higher growth metrics. If you are a leader in a stagnant industry, the chances of your growing your profits would be limited. Whereas, if you are a leader in a high growth industry, then the structural growth story of the industry itself will lend you ample room to do better. Clearly, industries which enjoy fundamental tailwinds tend to perform better than industries that don't. It is important that such companies are led by strong leadership teams with excellent track record of execution. Such teams should bring to us good corporate governance and strong financial discipline. When your governance is good and you are very good with money, shareholders tend to benefit the most. We are secure and we are also rewarded. Importantly, buying businesses which can be very heavily disrupted can lead to a lot of pain. In Solitaire, we hope that we are able to manage our investment approach with far lesser pain than otherwise aggressive investment approaches manage. So, it was very important for us to look for companies which are insulated from disruption for a foreseeable future. For example, you are not going to replace footwear or cosmetics in a long while to come. We like such businesses and several other businesses which supply consumables to engineering industry. So we wanted the industries to be insulated from disruption for the foreseeable future. We did not want to invest in companies which don't enjoy reasonable valuations. We wanted the valuations to be reasonable. The reason is that if we don't overpay, then our investment gestation will be more modest. If we overpay, then we will have to participate in a time correction, especially if growth does not meet our expectations even for the briefest periods. Lastly, we preferred not to buy companies with high leverage. So, we restricted our investment universe to companies with zero debt or very low and modest leverage. So, by doing that, we ensure that when the companies do well, the benefits come fully to the shareholders. So, there won't be loans to be repaid, there won't be interest to be paid. So, the company's EBITDA would only have two variables. One would be depreciation and other would be taxation. And if the companies don't have too much debt, by inference, they won't be asset heavy. So, with the tax rates also low, our investors have a better chance to get a higher growth in profits in their portfolios. That would mean that over the medium term, when the economy comes back to growth, the solitaire investor will be able to outperform investors who take far higher risks. So, what we were looking for were traits which help us stay invested, grow our investments, scale up, and prepare our portfolio for growth. So, in the gestation towards better growth, we wanted the investor to have a very comfortable journey in which he is able to confidently invest more money. And that, in essence, is the solitaire way for you. Thank you very much.